interesting to see regulators, ex-regulators, and physicians getting into the space of digital assets. So what more could we ask for?
Millions of people that have made significant wealth on chain. That wealth is just not compatible with traditional finance rails.
The Swiffy comments before around networking and networks, there is much more integration of regulators globally on how to do this.
In fiat, every dollar of fiat outstanding supports $4 of transactions. So it's more than 10 times more efficient to use stablecoins. So guess what's happening?
We can come up with regulations that help us and help the people not burn down those houses and use the same fire for cooking.
And every time a scam or a bubble or something like that happens, there's a shout, something must be done. This is something, hence this must be done.
If we can show that it works well in the hotel world and that you can tokenize it, because a lot of people are afraid. People are in crypto because they're like, oh, everybody else is doing it, I want to do it. But a lot of them don't understand it at all.
Good afternoon, everyone. Welcome to UAE and welcome to the day one of this great marathon of events that we have for the next 3 days. And what more could we ask for, and especially for me, a lawyer working in the digital asset space, to have the first panel, the opening panel, to be my favorite digital assets to talk about. And this is a panel that, anybody in this space would be actually dreaming of. You have the regulators, you have the funds, you have the money, you have the tokenization company, licensing authorities, all that you could ask for. Even though an introduction's been made, I would still want my panelists to come and just talk 30 seconds or up to a minute about themselves. I'm going to start with myself. My name's Kokila Alag. I'm the founder of Karm Legal Consultants. We're a boutique law firm based out of ADGM. Very proud to be saying that we're an Abu Dhabi homegrown company that has worked thoroughly in the digital asset space and now expanding into the other tech sectors. So very excited to be here. Miguel, we'll start with you. Just introduce yourself and then we go on.
Yeah, thank you, Kokila. Can you hear me? Is this working okay? Okay, all right. So good to meet everyone. Miguel Kudri, co-founder and CEO of L1.co. We are the operating system for on-chain wealth and asset management, and essentially we allow wealth managers, family offices, multifamily offices, hedge funds, and clients to work together in a fully non-custodial way, directly on DeFi protocols, on the very cutting edge of on-chain asset management. So excited to be here and looking forward to the discussion.
Thank you. Also really good to be here, but also a resident of Abu Dhabi, so it's good to welcome so many guests to our great emirate. I'm in ADGM. I lead the markets team. So the context of today, we'll talk about digital assets, but we also regulate other markets as well across commodities, securities, derivatives, and the like. ADGM put in place its regime for digital assets back in 2018, so it's a really good time to continue the conversation. Thank you.
Hi, everyone. I'm a relatively new resident of Abu Dhabi, 18 months. I love it. My day job is focused on delivering asset management solutions in the digital sphere to institutional clients. And my night job, I should flip that because I do that mostly at night out of New York. And then my day job is I'm in Abu Dhabi. We have a piece of technology that's regulated inside of the Reg Lab of ADGM that intends to bring institutions on chain. So an end-to-end platform that gives you kind of a Web 2 interface, end-to-end platform of creating and trading and selling natively digital assets. That could be something as simple as short-term paper. It could be something as complicated as markets in outer space. So very, very exciting time for the technology. We have a nice tailwind being in Abu Dhabi. And again, thank you for your time.
Thank you. Hi, good afternoon, everybody. My name is Amit and not Dr. Sameer Al-Ansari. I come from the northernmost emirate of Ras Al Khaimah. I represent RACDAO, which is a licensing authority for infrastructure level non-regulated entities in the digital asset space. Backgrounds, I've served 10 years in banking with Citi and a few private offices in Southeast Asia. Worked with Hedera for a couple of years and been with RACDAO for about a year now, helping and bringing businesses from all across the globe into the economy of UAE and supporting them with regulations, supporting them with infrastructure and support. And yeah, looking forward to kind of contributing to the panel.
Hi, Bhaskar Dasgupta, ex-banker, ex-civil servant, ex-regulator. I worked with that young man over there. Now semi-retired, run my own family office, invest partially onto crypto and on the board of several firms.
Hi, my name is Suraj Reddy. I'm actually actively practicing physician in the U.S. In the U.S., Indians of my origin actually make up a large percentage of the practicing physicians, and with our net worth, we actually like to be game changers, trying to find risks, high risk, high reward, and trying to find ways to invest our wealth. And my parents and my family actually also have a background in real estate, so I started passively investing in real estate for about 25 years. And then recently I moved into actually actively and starting my own company with my partner. We co-founded a company called Voyage Capital. We started off with just regular funds and syndications. And then we moved on to an actual fund. And now we moved on to tokenization within that fund.
Interesting. Very interesting to see regulators, ex-regulators, and physicians getting into the space of digital assets. So what more could we ask for? We're going to start, Miguel. You touched and talked about straight going to DeFi and talking about doing asset management or conversion tokenization straight away into the space where regulators still haven't caught up. So that must have been an interesting part for you to straight away get into that tokenization and skip the rest of it.
That's in short, that's right. We did it because we personally are crypto native individuals. We are very much in the trenches as investors. Before we started the company, we were investors and users of various different DeFi and crypto projects. And we've been lucky to generate some wealth, and that wealth sits fully on chain in crypto. And when you speak to other people like myself, there are now millions of people that have made significant wealth on chain. That wealth is just not compatible with traditional finance rails because they're just not connected. It's like you have information on the internet, and then you have newspapers. Traditional wealth and asset management is still in the newspaper era, and then you have crypto native money and assets that give you all of these. It gives you access to 24/7 liquidity, different use cases and applications that you can do with your money, and then we just couldn't find traditional financial advisors to work with us. And we kind of built a product for ourselves without necessarily looking at the regulatory landscape. We only found out that it was going to be an uphill battle from a regulatory perspective. The first week that we actually launched the company and we quit our jobs, Three Arrows Capital collapsed, and then FTX collapsed. And we thought that was going to kill the company, but it actually served as a tailwind because people understood the importance of self-custody and actually being kind of your own custodian, and that's been the ethos of our company. So, I think regulation defines everything that we do, but we didn't start the company because we wanted to fit a specific kind of regulatory framework. We started it because we had a need, and it turns out there are millions of other people out there who have the same need, and the market is going into that direction. So I think regulators will catch up and will provide guidance, and then we'll adapt to the new guidance as it comes.
Amazing. Just before we move on, do we actually see a lot of interest from family offices in large institutes, like other than the one that we talk about in the US or in Europe? Do you see that globally now when you're out of the US? Do you come across family offices actually interested more in the digital assets, or what we say the virtual asset space, or DeFi? Or is it all in one blanket that they're all?
Yeah, so I think it depends on the jurisdiction. Outside of the U.S., there's a lot more volume of family offices that have been dabbling in directly on chain. Generally speaking, you see most exposure on the venture side of things and on the hedge fund side of things. With FTX, unfortunately, many family offices were caught up in the situation because they were exposed, or they were invested in hedge funds that had funds in FTX, and that actually pushed a lot of family offices into self-custody, especially outside of the US. And so now you have hundreds of family offices, thousands of these individuals and institutions that have been sitting on self-custodied assets. Many of them kind of got in the last cycle, so very much low basis costs of these crypto native tokens, and they now want to put those to work, and so that's where they turn to DeFi, and they can start doing things with those assets that they've been sitting on since previous cycles, and that leads to other things like tokenizing alternatives and getting into diversification and income strategies and a number of things that we can talk about later too.
Amazing. Moving on to you, Simon, on this, when we're seeing a push in the demand from the market and the whole macroeconomic events that we are seeing globally, we'll discuss the weekend event much later, but right now more on understanding from the market trends. UAE has been at the forefront of it, and you've been pretty much the first ones globally to come out with the regulations. I think if we start just a little bit on that journey to where we are, and then we go on from there. Yeah.
It's a good topic to discuss, and I think we're never tired as ADGM and FSRA to talk about that journey, because even listening to Miguel talk about the concepts now of self-custody, I mean, if you look at so much of the industry, if you look at crypto exchange, for example, they are different for a number of reasons, and one is they require self-funding. So if we look at how the models might change, there are no rules. Regulators won't say every exchange must be self-funded. Some will say, how do you fund your client accounts, and how do you move those accounts, and what happens? That's key. And it goes back to where we first looked at it, and where we still look at it now. What was missing in 2018 when we started to look at designing a framework was, hey, that entity looks like an exchange, it should be regulated like an exchange, or that is a custodian, or that is a broker-dealer, that is a fund manager, that's someone arranging, that's someone providing a payments rail. They're all things that regulators can understand. So that's how we start to think about things. How is the product tokenized, or is it conventional? How do we seek to regulate that? I think a lot of that thinking still is how we think about things generally, but we didn't see things 7-8 years ago. Stablecoins weren't really around.
Yeah.
Staking, yield, those sort of products wasn't there. Tokenization of real world assets wasn't there. But they're all things we can have a conversation, and we do it every day. We've got members of our business development team that are here. We work closely with them to understand these models. The secret as a regulator, where we can try to engage with industry, is to understand and provide some assurance and flexibility at the same time. We don't profess to know all the answers, we never do. The idea is to have the right firms coming to jurisdictions like ours to say, this is what we're thinking of doing, how does this fit, how can you work with us to do that? That's really exciting and really interesting. In all those years though, from when we started, we were one of the first jurisdictions to say, if you are a crypto exchange, if you use that parlance, we are going to regulate you like a crypto exchange. We thought at the time we were going to be way out there on our own. If you look at history since then, absolutely not. The other regulators are catching up in that space. How they give a license, how it works is very, very interesting, and really hitting the Swiffy comments before around networking and networks. There is much more integration of regulators globally on how to do this. So once upon a time, regulators were very much focused on their own jurisdiction. We'll regulate what we can regulate. You keep doing what you're doing over there. That's really not what's happening. Regulators are discussing this all the time to try and work out how we can allow a business to operate cross borders and all those other things that firms want. I think that's going to be key as well. So we have to work not just for Abu Dhabi or the UAE, but also to connect, and we'll get to the commentary later, I'm sure, on the US, but connect to regulators in the US to make sure that US firms can operate there and here as well. That's the key. How we get there, how long it's going to take, we feel like 7 years in, the journey's just started. That's okay, ADGM's only just started relatively as well. But it's very, very exciting, very, very interesting. What I would say, it's also very tiring. So the models are so different and so exciting and so different. I wish we had more time to engage and understand it, but it's getting quicker and quicker, which I suppose is a reflection then. The last point is the industry is more and more wanting to come and talk to us. I think that's a good thing.
I know one of the facts that I always remember when you came out with the framework in 2018, and I think in 2019 itself, we saw a reference to a fiat-backed token. So yes, we see the stablecoin regulations now and catching up, but ADGM, I think, was way ahead of its time to actually start thinking and engaging. And I remember in 2020, we had a long discussion on a DeFi platform. And then from there to where we are, and Martha, that brings me to your project where you talk about being in a reg lab with ADGM. Now that's something that we talked about, sandboxes and saying that let's experiment. And you're already doing it, so that must have been again another experience to share here.
Yeah, it's been super engaging and super interesting, and I think, when maybe I take one step back. By the way, I really like the red. It's very effective. It's very effective branding. So I grew up preoccupied with taking things apart and building them. So plumbing, I think of that was, and my father was kind of puzzled because he's like, they migrated to Canada, and they said, we didn't come to Canada so our kid could become a plumber. And I graduated over to central banking where I was looking at plumbing and data. And my interest in the digital ecosystem was from that lens. And the backdrop is that everything we do becomes better, cheaper, faster, just by definition. We're never satisfied. The phone's really good, make it better, cheaper, faster. And we're really good at it, and we do it. And we're going to keep doing it. We're going to end up on Mars and doing all this other stuff because we're bored. 24 hours is a lot of time to kill. So you got to find ways to fill that time, right? So you experiment, you have fun. So digital assets to me is better, cheaper, faster. Where we see it very clearly is in stablecoin. So we integrate stablecoin into our platform. So how do you go natively digital? Well, you need a natively digital unit of exchange. What's our natively digital unit of exchange? Stablecoin. It's dollars. Dollars, interestingly enough. Their fiscal position is a disaster, and everybody wants to use the dollar. It's fine. So now, that's the past to some degree. Stablecoin are now a proven commodity. It just needs regulatory clarity. So now, what's the value of a stablecoin? For every dollar of outstanding stablecoin, we can support $50 of transactions because everything happens atomically. In fiat, every dollar of fiat outstanding supports $4 of transactions. So it's more than 10 times more efficient to use stablecoins. So guess what's happening? PayPal is going to use, they're not going to use banking rails, which are just another version of the inefficiencies tied to fiat. They're going to move away from those rails, and they're going to move into using stablecoin as the background. No one's going to know they're using stablecoin. They're using PayPal, but it's going to be stablecoin. What's X going to do? Yeah. X is going to become an everything app. That's been Elon Musk's vision with PayPal originally. Now he's going to compete with PayPal. So what's he shooting for? Money transmission licenses so he can use stablecoin to become a money transmitter. This is going to be a global money transmitter. Okay, all of a sudden we're changing the way we think about transmission and banking. Interesting. And you think, okay, so where do we go from there? Now you need to bring people on chain. So now we built a tool to bring institutions on chain so they can see it. They can live the experience and say, oh, geez, my middle and back office can now be done with 15 lines of code because the data sits on the blockchain, it's trustworthy, and it's known, secure, terrific. So where are we starting to see that next stage of innovation in the context of bringing people on chain? The most recent example, take a look at Sony. Sony now has a layer 2 on Ethereum. Take a look at everything that they're connecting to. Chainlink, Circle, Optimism. These are all the infrastructure components that are necessary for an on-chain future. If you're interested in infrastructure investment in blockchain, Sony's telling you what to do. Now, why does Sony want to create their own walled garden? They don't want people to come in. Quite the contrary. They want everyone to come in. They have IP. If I want to use a Sony song, if I want to use a Sony movie, whatever it may be, I got to go into Sony's walled garden because they have the IP to use that stuff. And they say, well, if you enter the Sony on-chain experience, you can use our stuff. 14 million wallets have been used in their testnet platform. 14 million wallets, 47 billion transactions in testnet. There are 4 million active wallets in the US. Sony just brought on 14 million more with one click. And we're just getting started, per Simon's observation. This is all getting started. So then what's the next step? So if I could think of the next step of where all this stuff heads, there's definitively going to be a convergence between blockchain technologies, all the things we're doing on assets and blah, 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 and AI. They have to converge because what is AI short? They need secure data that's transparent. Blockchain solves that problem. So if you need transparent data that's secure, you're going to use the blockchain if you're a robot. Or put it differently, robot to robot, they're not going to sit there and exchange fiat. They're going to sit there and exchange digital dollars or digital dirham or whatever it may be. So that convergence is going to be really, that's the future. That's the distant future, to be fair. It's not around the corner. But I think those are kind of the stepping stones if you were to think about your journey into the digital asset space. Now, our technology kind of fits somewhere in the middle there, where we're taking these digital dollars and moving up the value chain and turning them into more interesting investments and giving people the experience of migrating on-chain.
Amazing. It just makes me think that, Simon, this must be keeping you awake in the night, thinking about now I don't have to just come out with regulations which are for us humans and professionals. Now I have to care about the robots also who are going to do the tradings, the AI agents. And AI agents are, just brings me to discussion with you because I recently saw RagDAO's coming out with a license for AI agents. And that's interesting. Now just the DAO framework, which is something that everybody should hear about. Because we've seen so far a push for financial regulations, financial product of digital assets, but then RagDAO's gone and looked at the entire non-financial element of it. So maybe just a bit on that, yeah.
No, I think interesting observation, and I'll just kind of build on what my fellow panelists have been speaking about. My background, as I said, is working with a layer 1 in the past and working with the builders developing solutions. And there's always been this talk about regulations applying to innovation, and I think everybody agrees that innovation is right on the edge of what current regulations are. So there's innovation happening that kind of allows regulators to come up with frameworks. You see fire and you say, oh, there's fire. Fire can be used for cooking, right? But fire can also be used to burn down a house. So regulators have to kind of create those guardrails to allow the fire to be used in the right way so that people are not harmed. On AI agentic licensing, and I think this is industry-led feedback on what we are thriving and kind of developing solutions on. This was a chat with Solana ecosystem about a couple of months back where a lot of builders were developing AI agents. Just for clarity, we've not created a license for AI agents, but developers of AI agents, meaning giving out specific licensing frameworks for people who are developing AI agents so that they can come in the UAE, carry on with the good work they're doing, and we provide them with infrastructure. And that's just one of the licenses that we've created along with the DAO framework. There was non-custodial wallet framework, and we're proud to say that we are one of the first licensing authorities in the world to come up with a non-custodial wallet framework. And this is just to kind of, I'd say, provide what do you call, an important recognition to people doing specific work and not grouping them in software development or not grouping them in anything that doesn't apply to them. So they can just carry on with the good work they're doing, and we learn on the go. As Simon said, right, we are constantly looking at what people are building and how, as a regulatory body or a licensing authority, we can come up with regulations that help us and help the people not burn down those houses and use the same fire for cooking. But yeah, it's a constant learning experience. The advantage has been that we have people in-house who understand the space, who see how regulations can help build the right innovative platforms, and we're constantly on the move of doing that.
Yes. Moving on to you, Dr. Bhaskar. You've been on the regulator side, now involved. We do know that you sit on a couple of board of family offices and fund management companies, and also running your own family office. Do we see a lot of interest coming from these offices or from your clients that you see in the digital asset space?
So, answer is yes. And I would say anything between on an average, 2 to 3% is going into what I would call as broadly the virtual asset piece. My own, I'm really now touching about the 10% of my investments into this area. So I would say yes, it is substantially increasing in terms of the family office space that is going in.
And we're seeing that across. We're seeing that here in UAE. We're seeing that in India. We're seeing it everywhere. And
so let's put it this way: the behavior is driven by pockets. So, for example, you mentioned India. Obviously, the imposition of the capital gains tax has made it extremely difficult for you to, if I may, properly invest in crypto. But the Indian investors are finding out quite a lot of different ways of investing in them. If you're looking at the Far East, quite a lot of family wealth actually is in crypto. And those don't show up in official statistics, obviously. Same thing is happening, of course, in the UAE and GCC, although you'll see the difference between how the regulatory treatment or the official treatment, if you will, is within the GCC itself. In Saudi, tumbleweeds. But if you go to Bahrain or the UAE, happy days, right? If you move into emerging markets, there's quite a lot of interest in that. Europe, continental Europe, not so much. UK, yes. US, definitely.
amazing. You know, when we say that there is a push from the market, again, the market gets divided into different segments, and that's what we'll discuss it, that what actually defines a crypto market. Is it the family offices, institutional investors, or large asset management companies coming into this space, or actually the retail-driven market space that we're talking?
See, one of the things, and obviously my colleagues from the regulatory side may have an opinion, the entire structure of regulation that we have built up was obviously driven after almost about 200, 300 years of going back to, for example, the South Sea bubble or the orchid mania, that you need to protect the retail investor. And every time a scam or a bubble or something like that happens, there's a shout, something must be done. This is something, hence this must be done. Hence the rule book keeps on growing, right? You keep on trying to protect yourself from others, with one exception. Since Bitcoin and virtual assets have come out, the range of retail investors who have gone in is mind-boggling. Now, if I compare that to, for example, in Indonesia, where retail equity trading versus the crypto trading, there's almost about 50 times. Now, the cycle has gone down, and there's been absolute tons of shitcoins out there. People have lost their shirts. But one thing that you haven't seen are demands for more regulation. So this is where, to go back to your point, I am not convinced that those traditional ways of defining customers or the way you look at it or in terms of protection is right. We have to look at it from a slightly different perspective.
Absolutely agree. One of the things that I would actually like to discuss at some panel would be that every regulator's focus is customer and investors to be, to provide enough safeguards around that retail investor to be protected. The market is showing it. Do these retail investors actually want that protection?
Suraj, can I jump in before?
Yes, sir.
Regulators, I correct that statement slightly. Regulators are doing two things. We're trying to protect retail clients, but that's not all. We're trying to protect institutional clients, and we're trying to ensure the market has certainty on how it operates. Bhaskara's point's key. What we're seeing right now is no longer spot trading by retail investors into an exchange. It's derivatives trading with direct clearing on high leverage and auto liquidation of a position in a market. That is massively different. So I'll stop there because I think this is a really important point.
Yeah.
What the market's got to do is work out those regulators that can have that conversation first of all, and we're one that can. Work out what the risk tolerance is. The difference is at the moment with non-consistent regulation globally, there is still a potential for firms to go and say, hey, I'll go and get a license over there. It's off the back of a coin, it's off the back of a truck. I'm now operating, it's okay, with no real provisions to protect clients and others as well. Client protection's key, but settlement, recording of a transaction, clearing, leverage, holding of an asset, if it's in a fund or others, proper classification of an asset. Is it a real world asset? Is it derivative? Is it a commodity? All those things have got to be on the table before we can have a proper conversation.
Absolutely. This classification and recognition for tokenization or digital assets has been a must, and it's really commendable to see it as in almost like a span of just a decade that we have these clear definitions. Now going back to you, Dr. Suraj, coming from a physician background where everything is defined, to come into the space of tokenization must have been an incredible journey. So
I guess to start, first of all, with the real estate side in the US, the real estate market itself is double the value of the equities market in the US. And, we started in that real estate market, and we're in the in the hospitality and more in the hotels. So we wanted to see how we could disrupt the market. A lot of the funds and what's out there is looking at US investors investing in US real estate. And we wanted to find a way to globalize it and let global investors invest in US real estate, or to allow global investors to invest globally everywhere else. So, if there's a stable coin, so we're working with a stable coin that allows that, because then you can allow anybody, retail investors around the world, that can now work through a fund and invest in US real estate. So what we're working with is we have a stable coin that has full capital protection. So it's dollar for dollar backed by US Treasury bond. And that's not new. There's Bittlecoin, Ondo, all these coins that do a similar thing. But we're offering also a way for them to attach it to a real estate of their choice. They get to pick between all the ones that are out there. And then that gives them a way to get business income. It gives them a buyback assurance also is provided. So they're able to take their coin, trade between people, assign to real estate, and be able to actually make income and have a minimum assured yield and have capital protection, have buyback assurance. So it's a little way to disrupt and allow people around the world to invest.
It's amazing. I think, Simon, you would have a lot of points on this because we are talking about a stable coin, which is a fiat 1:1. We're talking about rewards, we're talking about dividends, we're talking about real estate, capital gain, we're talking about fractional ownership. So this is what a regulator looks at it and saying, wow, these are all these financial products coming together on just one platform. And this just makes us talk about that 2025, will we see more of these? Because 2024 saw a lot of hype in stablecoin. AED-backed stablecoin regulations came out from the Central Bank of UAE. RWA tokenization is what everybody talked about, that, you know, we're going to see more than trillions of dollars going into the whole RWA tokenization. Real estate is one of the sectors in it. And then we have the meme coins. So we have the extremes. So what do you think 2025 actually brings in?
Can I give some use cases if that's okay?
Yes, please.
Yeah. So Simon might remember it. I've been through 3 failed attempts to tokenize a fund here in Abu Dhabi. Didn't quite work. Started, didn't work. Gave it up. No, the market wasn't just there, and we were trying to do something that the market just didn't work. But now what we are seeing with one of my particular firms, who looks after somewhere around about $3.2 trillion, is that every unit of a fund is actually a token. So why do we actually have to take that particular ecosystem off of allocators coming into funds, and then going through the jump that you have to do is to take it through custody, through to payment rails, bring it back. So can I actually have a stable coin equivalent, but the stable coin equivalent is of a fund unit? And can I deal with that? The second thing that has that we are looking at is, for example, raising capital. I met with somebody, he does a very large manufacturing billion-dollar business in Kizad. Somebody told him, why don't you do an IPO? He's trying to exit. And I went and told him, are you nuts? You want to do an IPO? Yeah, but how do I get my money out of my company? I said, you're going to spend 5 years. Right now, you don't even have a board. You'll have to wear a suit. If you become an IPO company, it'll be easier for you to do it private placement, or why don't we just tokenize your shares, and there'll be lots of people who will be buying it out. So the point that I'm trying to make is that if we are talking about what's going to come out in 2025, I think 1,000 flowers will bloom. But at this moment, if you see what is actually landing, is the stablecoin market is definitely working, simply because the equivalent traditional way of using the underlying asset, whilst it was quite liquid, like currency notes or payments or money market funds, once you tokenize, the operating cost drops even further. So those things, the very liquid stuff is going to get disrupted. Right now I'm working with a custody provider who does virtual assets, but previously we were thinking about let's expand into traditional assets. Mm-hmm. And then last year we decided to stop. No, sort that. Because I don't think it's worthwhile doing backward integration.
It's interesting space to be in where, you know, the liquidity lies in one sector. How do I bring that from there to this whole space of the highly regulated illiquid stocks? And especially real estate is one of the sectors that we see a lot of market push. Regulators still, because it's not just a financial regulator when it comes to real estate. We're talking about land departments, we're talking about authorities, and who've been doing it for years and years in a certain way. To disrupt from there is a long way still.
Yeah, I'd like to just add a little bit on this issue, because I think it's very important. We have to be really careful with buzzwords as well, because let's tokenize stuff. All right, let's tokenize the table, let's tokenize the Burj, whatever it may be. We have to be really careful what the objective is. Better, cheaper, faster. Go back to that principle. So if I have an asset, and that asset has costs associated with it, building the fund, whatever it may be. Now I'm gonna mirror that asset in token form. I'm duplicating costs. Is it better, cheaper, faster? Maybe, maybe not. If I can move it around for collateral, maybe, probably not. So then why does BlackRock do it? They do it because they want to see how it works to decide whether they're going to go from 100 million or 100 billion to 4 trillion. Not because they think that vessel's the future. The future is getting all of this stuff on chain. So if your IP is on chain, if your legal is on chain, if all of this stuff is on chain, now I can write a smart contract that points to all this stuff on chain and make it better, cheaper, faster. To do that, you have to go natively digital. So then think of the parallels historically. None of this stuff is new. We can feel like we're on the outer edge, the tip of the sphere. Nonsense. None of it's new. When we used to have paper bonds, I loved Disney bonds as a kid. You got a little coupon with the Disney bond, and the coupon on the Disney bond had a picture of like Pluto or whatever it was. Those are now no more. And we migrated gradually to electronic bonds. Now, what's going to happen in this world to me? You're going to get convergence. So there's going to be a share that's trading on ADX. What would I do? I would have that twin asset trading natively digital on an exchange. And then it's the same asset, same principles, same regulatory regime, and they're going to trade in parallel. And if the price is off, some hedge fund out there is going to make sure they're the same. So then what that's going to allow ADX to realize is the digital realm is better. So then you're going to migrate away from electronic to digital. And that's going to be a gradual transition. And then we're going to be completely natively digital. And I think that's the objective. The objective isn't to just get that table onto the blockchain. That doesn't help us that much. The objective is to get all the infrastructure on chain so we can realize the back office and middle office efficiencies and give clarity. Look, the regulators are going to see all this stuff in real time. It's better for them as well.
I would like to add something very quickly on this, and I think taking it from Marcel, better, cheaper, faster. We agree that blockchain does that for any and every industry, right? But again, my personal opinion on this is not every single tokenized product need to go through that financial regulatory framework, right? There's infrastructure, and then there is the financial tokenization, if we may call it. And while we are kind of looking at infrastructure, which is pushing the boundaries of innovation, there's data being tokenized. Do we need to put that tokenized data on that financial framework and kind of issue licenses or define regulations for that? I don't think so. That's stopping kind of innovation on that side. So there needs to be a typical, differentiation of what needs to be regulated and what doesn't need to be regulated. And I think we're still trying to define that. Take an example of RWAs, real estate, for example. Does it need to go through that financial framework that's been traditionally set for bonds, for securities? I think no.
I wanted to bring back up a point that was raised earlier of investor protection. At least in the US, investors have been so protected that, millions of individuals have been kind of left out of very lucrative asset classes. And, we are so protected that, if you're not accredited, you can't invest in, venture. And these are seemingly riskier asset classes. But when you look at all of the stuff that these non-accredited investors have access to, the risk reward profile is just not close to where it's at. And so there's a lot of disillusionment among retail investors with the traditional system, and it's why crypto is such a self-directed kind of asset today, because it is fully open for anybody to participate. And sure, there's a lot that should be done to create rules and guidelines on how to kind of structure the market. But stable coins and all of the volumes that we're seeing are really the test case for what's to come. And so when you think of RWAs and all of these private assets and all of these asset classes that have been historically not available to the mass retail kind of investor audience, there's a very interesting opportunity here to tokenize them, but tokenization in and of itself does not kind of just magically create liquidity and create markets. Whether you're tokenizing kind of an offline or off-chain product, or you're issuing a crypto native product, what's going to happen is you're going to enable really efficient price discovery of various different assets that have various different risk profiles. So whether it's real estate or private credit or private equity, you're going to be able to suddenly create an open market where anybody can lend US dollars or fiat currency, and effectively you have the supply side of a stable coin that has yield, because we're now starting to see yield-bearing stable coins, which was not possible for years, or which just wasn't done. And that yield is going to be tied to what the market is kind of pricing in terms of risk for various different assets. So if I buy some tokenized real estate, I can put that up as collateral and I can borrow against it, and the market will set the rate that I'm paying. And so you now suddenly have a market reference rate for each of these assets, and that enables price discovery. And so you don't need to have secondary markets or make these markets when you tokenize these products and just expect them to just get on the blockchain and start getting, allowing anybody to trade them. But you can enable very efficient free market lending dynamics. And I think that's when, if I'm I don't know, an issuer and I'm sitting on these private assets, I would be seriously considering tokenization if it will enable efficient price discovery. Because I mean, in the future, it just enables more people to allocate to the asset class efficiently. It's a reason why a lot of these products have very high minimum check sizes, because it is very complex to allocate to those. But better, cheaper, faster. That actually crypto removes all of those pain points.
I was going to say, so echoing some of the things you said, I think by having the stable coin and allowing it to tokenize, you're giving access to somebody who doesn't usually have access to these things. So owning a hotel is something that people aspire to do, but like you're saying, that's usually an institution or somebody who's putting in $500,000 or $1 million. But by allowing you to tokenize it, you're now letting a retail investor at 30,000 come in. And the hotel is just proof of concept that you can do this with everything else. But why hotels to start is because hotels are something that, one, people want to aspire to own, but two is that it's what happened, it's all very publicly available. So you can Google how a hotel is doing. You can Google the STAR report. You can Google how it's done in the past. So people can access this data very easily in the hotel world. And it's something, if we can show that it works well in the hotel world and that you can tokenize it, because a lot of people are afraid, people are in crypto because they're like, oh, everybody else is doing it, I want to do it. But a lot of them don't understand it at all. So they're in that space, but they don't understand it. So to have somebody take their money and now put it into a real world asset in a tokenized version, people are hesitant. But when you're able to give them capital protection, buyback assurance, and give them all these assurances and make it a small ticket size, then in the hotel world, if you're able to do that, then you can go to land, you can go to student housing, you can go to multifamily, you can go to different places. And if you have a platform that works for that, then it works for everything else.
I'm sure, Simon, there's a lot that you have to comment on this.
It's a fascinating debate, and I want to pick up a little bit of what Marcel said before, which is our fear, if we be clear, regulators are not of the view that if you just tokenize something, it becomes an instrument that is protected or is fully tradable. There's two parts why I raise that. There is the infrastructure and architecture, and there's the asset. So we've flipped even in this conversation today around stable coins to crypto assets to technology for custody to tokenizing a real world instrument. And we've flipped even in that conversation between what is the activity and what is the instrument. If you look at what some firms are doing, and I'll raise the Coinbase example, they are trying to tokenize what we would call a security in another form from being electronic. If you go back 30 years ago, regulators of the world were petrified that we're moving from certificates to dematerialization to electronic ledgers, and now we're moving into blockchain technology for the purposes we're all talking about. But it's still trading, it's still holding an asset, you've still got to record it, you've still got to be able to do that. One of the concerns we see from industry is they will come to us, hey, we've tokenized, we had once before, we've tokenized watermelon and we think that is an instrument that can be traded. I'm sorry, it's still a watermelon, all right? I say that in jest, but that's where you can see the conversation being very clear. If we're talking about stable coins, that is in many ways used as a, if we be clear, there is a deficiency of fiat on-ramps, on and off-ramps, for many parts of the crypto world. So there's a utility for stable coins to be used to allow for people to trade an instrument in and out because there aren't those banking rails in place. One day when those banking rails are in place, using the analogy I think Bhaskar was talking about, that you can use as a payment provider, use a stable coin to transfer value. Is it a stable coin anymore, or is it an instrument being used for the purposes of payment? And so therefore, that's what we find fascinating, because in many ways, property is still property. You can tokenize property, but it's still property. What sort of instrument can it be held in, a fund or not? I only raise that because they're great points, and that's what we're looking at to try and keep up, to understand, and try and map it back into those different activities at the same time as simply trying to understand. It's really interesting. I'll stop there, but great points. But we do need to be careful to make sure that as in an industry, we are communicating very clearly for all the purpose you're raising. We do want retail participation. We do want retail investors protected. We do want to give them access to instruments. How do we do that? I guess we've all got to work together to work that out. And regulators, you may not hear that very often, want to be part of that conversation for all the reasons we can raise.
And especially in UAE, we see regulators actively involved in this space.
If I may just pick up on one part, I mean, over the last 6 years that I've seen tokenization, et cetera, real estate keeps on cropping up. A couple of points. First is, yes, you can break it down into small parts, but real estate by its very nature is highly illiquid. So whilst it's very easy to go in, but can you come out? Now, this is one of the reasons why the first question I would ask anybody who's trying to tokenize real estate is, does your business model stand without that tokenization? If it doesn't, then you're just putting lipstick on a pig. It will still remain a pig because there is no actual liquidity behind it. Now, what I've seen, and I'm very happy to be corrected, is that if you have a real estate asset which gets tokenized and you are promising it to be fully liquid, then you will have to actually have so much amount of capital put into liquid assets that your business model of the basic real estate piece doesn't stand up. And it goes back to the point why money market funds are being so successful is because there is an exit mechanism. So what people forget is that it's very easy to get into positions, but being a trader now for almost about 30 years, you need to have somebody else on the other side to buy it off you. Now, yes, the greater fool theory is there, but not always. So if you're talking about institutional pieces, you need to be careful about the other side.
No, absolutely. Real estate tokenization, RWA tokenization, all is what I think, again, 2025 is going to keep us busy. Just a disclaimer, throughout when we refer to stable coins, we're talking about the fiat reference tokens. We're not talking the algorithmic and the different asset class. But very interesting to see, and I think it would be a good opportunity for everybody in this room to grab hold of these extremely talented and well-researched panelists who can answer you more on these discussions, which we've not had here. And specifically, I go back to This year we're talking about stablecoins, RWA tokenization, meme coins. And we need to see how this year actually unfolds for all of us. I'm quite excited. And with that note, thank you everybody. It's been a great pleasure to be here and talking to all of you. Thank you.